now we're going to turn to the fixed income market in Treasuries. Let's take a look at the 10-year note. I think we have a full screen of it. Well, yields have been on the rise, just yesterday hitting the highest level in 7 months. Well, investors are also digesting this morning's U.S. economic data. We see low inflation, or at least it's trending that way, at the same time seeing rising industrial production. Well, after several weeks of good economic news, we're going to speak now to Morgan Stanley. They see fourth quarter GDP tracking at more than 4%. And joining me is David Greenlaw. He's the chief U.S. fixed income economist for Morgan Stanley. And based on data compiled by Bloomberg, he is one of the most accurate forecasters of the economy. And we call him here a Bloomberg best. Thanks so much for joining us, David.
Good afternoon, Lisa.
David, I want to get to the GDP forecast because I know that's a new issue, new report you issued this morning. But let's start first with what's going on in fixed income and Treasury yields specifically. The 10-year is close to hitting almost at sort of 3.5%, has risen, the yield on the 10-year, rising dramatically over the last few weeks. What's your forecast for the coming year?
Well, we've got yields rising further. We're at 4% for 10-year yields at the end of 2011. That's starting actually to look a little bit perhaps too conservative at this point because the Treasury market has been under a lot of selling pressure, and we expect the economic news to continue to be good for a while.
Let's talk about some of the risks to fixed income investors. I participated in a panel on distressed debt just a few weeks ago, and there was a lot of talk about asset bubble. Are we at that point? So let's talk a little bit about what's going on in 2011, or what trends you see that may actually hurt this market.
Yeah, so I think that there's certainly been a reassessment of the growth prospects in the U.S., and the pending tax deal in Washington is one of the latest developments there. That triggered, from our side, a 1 percentage point upward adjustment to our growth estimate for 2011 from 3% to 4%. I think also you've seen a little bit higher degree of comfort with developments in Europe. I think Europe is still facing some significant problems, but the fear of contagion resulting from Europe's problems to the U.S., I think, has diminished somewhat. So we're unlikely to see the same sort of flight to quality that we experienced back in the spring and summer related to problems in Europe.
David, I want to talk about one point made in the fixed income research report from Morgan Stanley. You talk about a lot of the overweight positions in bonds, a little similar in terms of supply-demand issues that we were just talking about in the muni market. We have seen over the last couple of years, and I think we have your chart, actually, a bar chart that shows just a huge influx into equities or into bonds, and we may actually see that reverse now.
Absolutely. So you're seeing, as was mentioned in your report, some redemptions in the municipal market, reflecting the deterioration in returns. I think that that is an important consideration on the demand side of the equation. On the supply side, we're looking at higher deficit numbers. So budget deficit in fiscal year 2011 expected to be more than 8% of GDP. And even though you're going to offset a lot of that temporarily with Fed buying, I think it's looking more and more like the Fed is unlikely to extend their asset purchase program. So at some point, the market's going to have to absorb a lot of Treasury debt.
Well, let's talk quickly, though, about inflation. One thing that everyone is paying attention to this morning is the CPI. Looks as if it wasn't as strong as forecast. Now, inflation is one of the big risks to bondholders.
Absolutely. And the numbers on the face of it this morning were quite benign, a 10th increase in both the headline and the core. But when you look through the details a little bit, there were some reasons for concern, I think. So in particular, the year-on-year rate for the core CPI ticked up from 0.6 to 0.8. Still very low, but I think that represents an important directional shift. And even though the monthly number was as expected, the core was 0.1 for the month as expected, that elevation in the year-on-year rate implied a shift in the seasonal adjustment factors. And in fact, it looks like like for the month of November, the seasonal adjustment factor lowered the core CPI by about 1/10 of a percentage point relative to what you've seen for the last decade or so. Now, seasonal adjustment factors have to average out over time, and it looks like you're going to get that 1/10 back in December. So at this point, I'd be looking for a 0.2 or a 0.3 for the core CPI in December.
David, quickly, let's talk about the strategy for bond investors in 2011. You're saying, because you actually expect the curve to steepen, get out of the longer duration securities.
Yeah, absolutely. I think that in an environment of rising rates like the one that we're in now, you really want to limit your duration exposure. And so you want to, if anything, move towards the front end of the curve.
All right, David, we have to end it there. Thanks so much for joining us today. That was David Greenlaw, Chief Fixed Income Economist from Morgan Stanley.